Hello again, Accounting 201 students. This will be our second PowerPoint from Chapter 2. I'd like to review first three important points about transactions that we learned in the first PowerPoint for Chapter 3. The first one being that each transaction is analyzed in terms of its effect on assets, liabilities, and stockholders' equity. Remember the accounting equation, assets equal liabilities plus stockholders' equity. Another important point is that the two sides of the equation must always be equal. And the last one is the cause of each change in stockholders' equity must be indicated, like if it were expense or dividends, for examples. In this part of Chapter 3 PowerPoint, we are going to explain what an account is and how it helps in the recording process, and define debits and credits and explain how they are used to record business transactions. If you remember back to the first part of Chapter 3, we illustrated how to record transactions for Sierra Corporation using the accounting equation. While this is a nice way to be able to do it for Sierras, there were only 10 transactions, and you can imagine most businesses have more than 10 transactions. Think about Microsoft or General Motors. Would this work for them? Of course it wouldn't. So what we have to do is to be a little bit more sophisticated, and that's why we use the account to classify events. When you are using the accounts, make sure you use proper account titles. We've kind of started using them already when we talk about cash and supplies and prepaid insurance. We're not going to say paid cash or received cash. We're just going to say cash or supplies. Whoops, sorry. In the simplest form, excuse me, an account has two parts. The account records the increase and decreases in a specific asset, liability, equity, revenue, or expense item. In the account, you have the debit side of the account, which is the left, and the credit side of the account, which is the right. We often call this a T account just because it looks like a T. You have the line here and here. Debit and credit procedures. We call this the double entry system because each transaction must affect two or more accounts to keep the basic accounting equation in balance. The recording is done by debiting at least one account and crediting another, and debits must always equal credits. Always, always, always. Now accounts usually have either a debit balance or a credit balance. The way you figure out which one that is you will add the two sides up, the debit side and the credit side, and then the bigger side is your balance. In this case, when you have $10,000 plus $8,000, that's $18,000, you have a $3,000 credit, so your balance is going to be a $15,000 debit. If credits are greater than debits, the account will have a credit balance. In this case, you have $10,000 debit. Add these together, it's $11,000 credit, so the balance would be $1,000 credit. When you're thinking about the debit side and the credit side and assigning it to assets, liabilities, and stockholders' equity, this is just kind of a visual of what you might want to use. If you think that accounting equation, make a T with it, you can see that assets are on the left side or the debit side of the equation, and liabilities and stockholders' equity are on the right side or the credit side of the equation. Remember that debit is always left and credit is always right. We can go further to that then to determine what the normal balance is for each of these types of accounts. We have assets. They're on the left side, so any asset account is on the left side. The left side of the equation is a debit side, so that is going to be the normal balance side. The normal balance side is also the increase side. Liabilities and stockholders' equity, both of them are on the credit side of the equation. We still make the T account, but you can see the credit side is going to be the normal balance side for any liability account. And then stockholders' equity account, the credit side is the normal balance side for those. We will talk more and take into account the fact that expenses and dividends take away from stockholders' equity. So their normal balance is going to look like an asset. Remember, debit is always left, credit is always right. They are not the increase side and decrease side changes. The normal balance is going to be on the side of the equation. Assets are going to be on the debit side, liabilities on the credit. That's going to be the increase side. Stockholders' equity, normal balance on the credit. Just to further illustrate to you again, assets, debits should exceed credits. The normal balance is always going to be on the debit side. Liabilities, credits should exceed debits. So you should have a credit balance. The normal balance is on the increase side. So liabilities, normal balance, credit. Assets, normal balance, debit. Stockholders' equity, thinking about that equation. Owners' investments and revenues increase stockholders' equity, so credit. Dividends and expenses decrease stockholders' equity, so they're going to have a debit normal balance, just like I was telling you earlier. Here's your stockholders' equity. These two will keep the credit as a normal balance. Dividends take away from stockholders, so they'll have a debit balance. The purpose of earning revenue is to benefit the stockholders. The effects of debits and credits on revenue account is the same as their effect on stockholders' equity. So you can see revenue will have a credit balance, and that would be the sales. Expenses have the opposite effect. Expenses decrease stockholders' equity, so they will have an increase on the debit side, much like an asset. When we're talking about stockholders' equity relationship, companies report the subdivision of stockholders' equity in various places in the financial statements. Common stock and retained earnings are in the stockholders' equity section of the balance sheet. You can see right there. Dividends are on the retained earnings statement. Excuse me, down here. And revenue and expenses are on the income statement. And see, they're right here. Dividends, revenues, and expenses are eventually transferred to retained earnings at the end of the period. As a result, a change in any of these three items affects stockholders' equity. Here's a summary of the debit and credit rules. Normal balance debit is going to be assets and expense. That's going to be the increase side, which we will learn more about later. Normal balance credit are going to be liabilities, stockholders' equity, and revenue. Again, just another picture. Assets and expenses increase on the debit. Liabilities, equity, and revenue decrease on the debit. And then just the opposite. Liability, equity, and revenue will increase on the credit, and assets and expenses will decrease on the credit. The relationship among the assets, liabilities, and stockholders' equities can be described below. You have your assets, debits and credits, increase on the debit side, liabilities, debit, credit, increase on the credit side. Again, if you remember from the accounting equation, those on the right are going to increase on the credit side. The reason dividends and expenses are opposite is because they take away from stockholders' equity. The equation must be in balance after every transaction. For every debit, there must be one credit, at least a credit. The exercise I'd like for you to complete now is exercise 3.6, part A only. And if you look on the Moodle site, there is a demonstration on how to begin it. Good luck!